Give us the elevator pitch for Lighter Capital. I'd love to hear that.
We have 3 different types of loan vehicles, but the first one, and the one that I think we're kind of more famous for, is what we call an RBF loan. So we basically loan early stage companies capital so that they can grow their business, and the repayment is basically scheduled on the base of your monthly recurring revenue. So we basically take a piece of the action every single month, right? So that way, as the company continues to grow and or fluctuate as they continue to move up and to the right, that their payment streams are a piece of their overall revenue. We also recently launched a line of credit, which is for more working capital types, and we also have a term loan, which is basically calculated and set up not unlike the RBF loan. It's just that we set the payment structure in a more predictable versus variable fashion. So we effectively help early stage companies that have either tapped all the sort of angel or early stage money that they can get, and they're not quite ready for true equity capital from typical VC networks, and or that they just have a desire not to get diluted at all, because obviously we don't take any warrants, we don't take any equity in the company, and we allow founders to grow the business without actually giving up any equity or control. We also we don't take any personal guarantees, and we also don't collateralize these loans. So we really judge the performance and the credit worthiness, if you will, of our loans and our borrowers based on the fundamentals of their business.
And once you get to that stage where you have a product and you're generating $1, like you've got your first dollar revenue, then your options start to expand a little bit, but you guys are one of the few that will actually take a real hard look at it. Like a bank would just laugh, and they're not even going to.
A bank would typically laugh. Even some of the notable tech banks,
sure,
back
SVB, all those guys.
Exactly. Yeah. So your options really at that point in time are either continue to take angel capital if you built a solid relationship with a group of seed investors. You could come to an organization like Lighter or one of our competitors, or you can try to go down the equity capital raise. So if you have some degree of success, you've shown commercial success, you've gotten some customers, so on and so forth. If it's a white hot space, you might get lucky, you might get a VC to jump in. But remember, especially super early stage like that, that tends to be extremely dilutive capital. And that's why Lighter has been so successful, so that we can jump in and help to grow to that next phase before you ultimately need really big money. And frankly, it also has a lot to do with the type of business you're in. If you're an extremely capital intensive business and you need multiple millions of dollars, that's typically a venture path. If you've got something that tends to flywheel, is more capital efficient in nature, debt often is a great way to go and a better way to go.
Yeah.